Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Noah Hamman, founder and CEO at AdvisorShares, to discuss investment strategies that can neutralize market risk. Noah, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me.
All right, you got it. And as the market continues to hit new all-time highs, we're climbing this wall of worry here. Noah, I guess the question everyone asking is it time for the market to take a step back? What are your thoughts here?
I don't know if it's time for the market to take a step back, and I only say that because we're in an election year, and it does feel like politicians want the market to do well right up until the election. But it's certainly time to start thinking about it, right? We may have a whole new change in a political environment here, which is seemingly coming maybe with a lot of policy changes, and that uncertainty in the stock markets can cause some volatility sometimes. So it makes sense that now's the time to start thinking about a game plan.
And when markets do start to move downward, how does the nature of correlation move with them?
I think in normal markets, you get a diversification across different asset classes. So stocks might be doing well, but then maybe bonds aren't, or bonds are doing well, then stocks are. But when things get challenging, and it does feel like we've come across or we've moved past some challenges, the global pandemic, we've had a few bank failures. I mean, it's been some challenging things going on, and the market hasn't skipped a beat. And so the thought process that we have is that, we could see some more volatility, more sort of financial crisis-like volatility, maybe not in the same area, but to the same size. And when that happens, as you saw back then, there was really no place to hide. So, equities did terrible, bonds did terrible, even gold and safe havens like that, places you think you can go to diversify, don't always work well for you. There's really only two choices if you want to get out of that correlation of a negative market, and it's cash. And sometimes that's tough to do because people don't want to be out of the market completely, or it's hedging to a certain extent, thinking about alternative strategies, a little bit or a lot. Market neutral is a type of strategy where you could, if you want, in a sense, short the market on one half, but also still be long with the stocks that you like that still may do well over time that you want to hang on to. And that's a way to neutralize that market exposure, at least for a little while. Maybe not all of your portfolio, but part of it. And so things like that are the types of things that investors could think about.
Right. And for investors, shorting the stock, the market, and index, it's a complex process, right? And that, that's something that professional investors do. Is there a fund or a way to mimic the shorting and going long?
Absolutely. And you're right. That's the thing for investors to be very cautious of. Shorting stocks is very risky. Stocks have an unlimited upside and only can go to zero on the downside. And so that is a big risk. And so it really is designed only for investors who understand it or working with financial professionals who can help them with it. And to your question, there is, there's inverse products out there, but the challenge with them is that they are shorting the broad market. And so you're shorting the good along with the bad. And so in that sense, you might just be better off going to cash. But there are a couple of actively managed short equity ETFs out there. One in particular is one of ours. It's the Dorsey Wright, Nasdaq Dorsey Wright short equity ETF. The ticker symbol is DWSH, and it uses the investment process that's well known for Dorsey Wright of relative strength, but it turns it on its head. So it's shorting the stocks with the highest relative weakness. And so it'll move through stocks. It won't always stay in the same ones. And what you'll find over time is you can add some value there. We looked at the market over the last 3 years to see what kind of results would be produced from just having half of your exposure in that short ETF. And just year to date, for example, the S&P is up, I think, roughly 7.85 as of the end of last week. If you were 50 short, 50 long using the DWSH ETF, you'd still be up 5.80%. So you're not getting all of the upside, but you've neutralized that market exposure. You still see same results looking backwards in 1 and 3 years as well. For the 1 year time frame, that blend would be 13.16%. In the 3 year time frame, 4.58, which doesn't sound great relative to the 12.58 that the S&P's delivered over that time. But remember, you're doing that because you want to reduce your market exposure. So you're not worried about capturing all the gains, but you also don't mind getting some positive returns if you can neutralize some of that risk.
So where would this fit in one's portfolio? Would you consider this a core holding?
I don't know that I would consider it a core holding, and I certainly don't think that most investors would do this with their overall portfolio, but the portion of your portfolio where you are trying to protect it more and manage that risk, some people will allocate some of their money in a very speculative way, or they want to stay more balanced. And this is money that you would look at to say, well, I want to try to protect what I've grown, right? People use concentration to grow their wealth, and they use diversification to protect it. And sometimes diversification alone doesn't provide that. And so this is an idea, I think, for part of that portfolio for investors, just to add a little bit of value. You're probably never going to get the timing correctly, as we all well know. It's the most difficult thing to do in investing, but just getting the cycles reasonably correct can add some value.
All right, no, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.